Okay, well, welcome everybody to this final seminar this term under the programme on the political economy of financial markets. We have this evening Malcolm Knight, who's going to talk about the G20 Reform of Bank Regulation and the next financial crisis, which I hope is not a consequence of those reforms, but is an analysis of. Malcolm began his career at the University of Toronto and LSE, where you got your degree and your PhD, and where you taught for a number of years. And then you went to the IMF, where you worked for about 25 years, which is where I got to know Malcolm. And then you left in 1999, and you became Deputy Governor of the Central Bank of Canada, and then after that, you went to the BIS, is that correct?
Yes, I was the general manager.
Right, yeah, so you were in charge of the BIS, right? So you goes from strength to strength. And then you were then vice chairman, you moved to the private sector, vice chairman of Deutsche Bank, with responsibility for developing a globally coherent strategy for group-wide work on regulatory reform and international financial stability. So you were yourself single-handedly steering one of the world's biggest banks into the post-crisis world.
In some ways better than others.
And then after that, you joined as a distinguished fellow of the CEDI, or Centre for International Governance Innovation, working on governance-related aspects of regulation, basically, financial regulation, and also on official international financial institutions such as the IMF. You had a sort of oversight of those on the research side. Also, you're currently you're Deputy Chair of the Board of Directors on Payments Canada, overseeing the payment system in Canada, and you're currently a visiting Professor of Finance at the LSE. So you're still a very busy man. And I'm very glad that we found the time to come and speak here at Oxford. So with that, I could go on actually. You have a list here of your many achievements, which would take the entire seminar, but I'm not going to do that. I'm going to stop now and ask you to tell us about G20 reform.
Well, thanks, Adam. It's very good to be here. I'm going to stand up because I have to do that to operate the machine. The titles may be a little bit dramatic. The G20 Reform of Bank Regulation and the Next Financial Crisis. Let me just, this is an issue that I'm thinking about, and I hope we're all thinking about it because it's really important. But let me tell you where I'm coming from. I think that the G20 reform of the global architecture of financial regulation is in general a very fine piece of work. I was involved in overseeing the IMF's work in banking system reform during the Asian crisis. And I realized how difficult a job it is to be restructuring banking systems in crisis conditions. It's a little bit like being a fireman. There are lots of things that you have to make decisions on quickly. And there are many things that if you had the information at the time that you get afterwards, you probably would have made decisions differently. These financial crises have very, very severe consequences. So it's really important to get things right. Now, I think what the G20 has been doing is a comprehensive reform that is supposed to touch all areas, not just banking, but also financial markets, derivatives markets, central counterparties, the shadow banking system, etc. That's the design, and it's a good design. It goes back actually to 2008, which was the first meeting of the G20 at the heads of state level. It was to try to resolve the financial crisis. And the plan that was announced at that time was already this comprehensive plan, which has been in course of design and implementation and its details ever since. The problem for me, though, and the one I'm trying to deal with here, is twofold. First of all, in terms of actual implementation, most of the measures that are being implemented or have been implemented are measures that increase the regulation of banks, particularly big banks, what are called the G-SIBs, the global systemically important banks. And so there's a little bit of a disconnect between what is happening in the banking system and what is happening in other parts of the financial system. And I want to talk about that. The second issue is that the G20 reform finally brought to the fore a realization that there must be macroprudential oversight of the financial system as a whole. And I think the problem there is that this is giving many people the impression that there really is a framework for macroprudential oversight, which will prevent another crisis like the one that started in 2007, or if we have one, make it much less dramatic and much less serious than it was the last time. And to give the impression that you have the capacity to do that if you don't have the instruments to do that can create very big problems down the line. So this is what I want to try to investigate by just doing some analysis of what is going on. Now, I think that one of the things that the global financial crisis did was to highlight this fundamental paradox of a modern financial system. We really need a pretty complex system to do a number of things. First of all, to efficiently allocate savings, particularly to fixed capital formation, to operate the payment system so that payments are sure and final, to provide a very broad menu of different types of financial instruments that will meet the risk and return preferences of many different types of economic agents that are not themselves in the financial system or that are in other parts of it, to allow final holders of wealth to efficiently diversify their wealth holdings based on their expectations of risk and return levels and correlations. And finally, very importantly, to facilitate risk transfer among economic agents through all types of insurance-type products. It's a pretty complicated system. And what the financial crisis, I think, revealed was that the system we had to do this, and actually it's pretty much the system we still have, did that pretty efficiently in normal times, but proved to be highly unstable under stress, at least under the particular stresses that began to appear in the summer of 2007 and reached probably their worst point in September and October of 2008. Now, when I look at the system, there are 5 sort of areas that determine both the degree of efficiency of the financial system in normal times and also have an impact on its lack of robustness when there are shocks. These are, first of all, leverage, which is just the assets of any institution relative to its capital. I'm not going to talk about risk-weighted assets here, because risk-weighted assets is a much better way of measuring the amount of capital you need to hold against the various types of asset risks that you have. But we don't have risk-weighted asset analysis for most of the sectors of the financial system. So I'm going to talk about leverage, and I think there are certain interesting aspects of it. The second is interconnectedness. We have these lending chains in which the savings of wealth owners are transferred through the financial system to the ultimate borrowers, not within one institution, but usually through a chain of institutions. And this creates interconnections that can cause runs that are like bank runs but operate differently. Third element is complexity, particularly G-SIBs, very complex institutions, and complexity and interconnectedness together breed a lot of lack of robustness in times of crisis. Fourth element is concentration. We have lots of small institutions around the world, but for example, in the United States, there are 20 institutions that really are the core of the financial system, even in a very large economy like the United States. Now, and then of course there are the business strategies of the core institutions. So these are the factors that I think are important in looking both at the efficiency of the system in normal times and its robustness or lack of robustness in times of crisis. Now, for 30 or 40 years now, the global systemically important banks, G-SIBs, I'm sure everybody knows the acronym, they have been the core of the international financial system. And these banks are tightly interconnected with each other, and they're tightly interconnected with the rest of the financial system. And it's very interesting that although the Basel III rules have and also market discipline, have very significantly reduced the leverage of those institutions, they're still probably the most leveraged, significant institutions in the financial system. Why is that? Well, it's because markets are not prepared to give 15 times leverage to most types of institutions. And the reason that they're prepared to give it to these large banks is because these banks are regulated. So they're still the most regulated institutions in the system, even though they're much less leveraged than they were before. And to me, this means that when there's a rise in leverage anywhere in the financial system, it's very likely to show up on the accounts of the banks and to affect the stability of the banking system. So whether the rise in financial system leverage takes place in the banks themselves or in their borrowers, it'll be reflected at the core in certain weaknesses that we're going to see. So that means that regulation is a kind of a trade-off. It's a trade-off between achieving sufficient stability of the system in normal times and ensuring that the system remains relatively efficient in terms of the size of the intermediation spread from the initial saver to the ultimate borrower. Now, there are two basic bank business models, as everybody knows. The classical originate-to-hold model, where banks basically hold assets, they make loans, they underwrite loans, they extend loans, and they hold them on. They do so with the intention of holding them on their books to maturity. That's a fairly simple model in which the consolidated balance sheet of the banking system corresponds very well to the levels of nominal GDP, nominal saving, and so on. Then we have a newer model of banking, the originate to distribute business model, and that's the one that blew up in 2008. It's the one where banks and other types of institutions that are also credit intermediaries, which we refer to typically as shadow banks, they package pools of assets, mortgages, car loans, student loans, other credit products into asset-backed securities, pass-through asset-backed securities, and then they are tranched, sliced and diced, so that packages are created through collateralized debt obligations that provide different risk and return combinations for different investors. Now, this is a very different model of banking. It's much more complex. Because what is really happening here, and it was a very interesting element of the crisis, is that banks are, in a sense, trying to increase the velocity of circulation of their balance sheet by packaging these products and then selling them off their balance sheet for a fee. And the faster you can do that, and the shorter the warehousing time of the assets is, the more the higher is the return on equity. Whereas with an originate to hold bank, the bank just earns the interest rate on the loan, however profitable the underlying business borrower happens to be. Now, of course, the largest banks that are active internationally, they operate a portfolio of business strategies. They have an on-balance sheet business. They have an originate-to-hold business, which is on an accrual accounting system. And then they have their investment banking operations, which are securities underwriting and market making and proprietary trading. So in principle, they're operating a diversified portfolio of businesses. That makes their business more complex, but it should also make it a little more robust if they're operating these businesses properly. After the financial crisis, there came to be a view that the originate-to-hold banking model is a stable business, a low-risk business, and the originate-to-distribute model is a high-risk banking business, and that what should be done is to direct banking back to the originate-to-hold model. I don't personally agree with that view. I think that view is totally wrong. If you look in the IMF, we had people who looked into banking crises post Second World War. There have been about 70 banking system-wide crises since the Second World War. And virtually all of them were crises of originate-to-hold banking systems. And I'll talk a little bit more about the frailties that caused that in a second. But I think the basic point I want to make is that the originate-to-hold and originate-to-distribute banking models are both very risky because banks are highly leveraged institutions. They have different types of risk and different types of frailties. In the originate-to-hold model, typically the problems are poor credit underwriting standards and poor credit monitoring standards, excessive maturity transformation, which usually is associated with weak liquidity, and the worst problem typically, certainly in emerging market economies, is evergreening, where I take out a loan, I'm the president of the country's nephew. At the end of the year when I'm supposed to repay the loan, I come back to you at the state bank and I say, well, don't have quite enough cash to pay back the loan with interest, but I have an even bigger, better project, which my uncle has approved. And so give me a larger loan. And so the interest is accrued on the balance sheet. The depositors are happy because the interest is accrued on their in their deposits, and this system can roll along until the solvency hole becomes huge. In the case of Chile's banking crisis in the late 70s or early 80s, it was over 30% of GDP, and that's because the capital's actually not there. And so that's a bad model if it's not operated properly. The OTD model has lots of frailties. I'm not going to go into them in detail, but it's high leverage, interconnectedness, complexity, and it also suffered particularly because the instruments that were being warehoused, structured and warehoused, were being sold off the balance sheet. the concern with the quality of underwriting declined. It was certainly aided in the United States by regulatory measures which also weakened underwriting, the strength of underwriting. But what I really want to say is both of these models of banking are very risky. Now I'm going to go through just a series of 5 charts which I think illustrate some of the points I've been making. And the first one may look to you like it's got nothing to do with financial crisis, but this is the Case-Shiller index of the national index of housing prices in the U.S. From the late 1980s to 2011. And there are 2 very fascinating elements of this chart, which I think really bear on my story. The first is that you'll notice that from about 1989 to 1996, that line's falling. That means that housing prices were falling relative to the CPI. This was at the very time when people in the mortgage origination business in the United States were telling people housing prices never fall in the United States. They'd been falling in real terms for nearly a decade. So the story that you often hear that, oh, the prices have never fallen before is not true.
In real terms.
Well, it's only relative terms that we're interested in. The other thing that's really fascinating is this huge increase, a 90% increase in the relative price of housing from 1997 or 1998 to 2006. That's unbelievable. Why is it unbelievable? It's unbelievable because that movement is a violation of first-year microeconomics. We know for sure in the United States that the housing construction industry is a constant cost industry in the long run. There are no economies of scale to speak of in the industry. There are no barriers to entry in the industry. And really all that you need to know in order to build a house in the United States is how to use a glue gun and how to use a nail gun. So we know that in an industry which has constant costs in the long run, the demand for housing can't affect the relative price of housing in the long run. So how could it get so far out of line? And the answer is because of this process in which people came to be convinced that what they were buying when they were buying houses was not housing services that were determined by demographics, but assets that would appreciate. And we can see that from this next chart, which shows that this huge rise in the relative price of housing was, of course, totally related to the rise in non-agency, that's called private label, non-agency, that's not guaranteed by Fannie and Freddie, non-agency residential mortgage-backed securities. As that went up, that produced the liquidity in the housing, in the household sector to buy those assets. Okay. So very much a financial phenomenon.
What's that chart showing? That all
chart,
the bits on the bottom don't relate to the title in a way that I don't quite.
Well, the title is not. I'm not intending to. The correlation's made between the two charts.
Oh, I see.
And what I'm saying is that you'll see that if you go back to the previous chart, you can see that the rise in housing prices is over exactly the same period.
And what's that picture? This second picture showing?
This is issues of non-agency. The blue one is issues of non-agency residential
I
mortgage-backed
see.
securities.
And all the other loans are those smaller numbers.
All the
I
other
see.
loans are
Thank
much
you.
smaller.
And that's a flow, is it?
That's a float.
Yeah.
Now, this resulted in a very significant crisis dynamics. You probably know this chart. It comes from Brunnermeyer and Peterson. And there's a very strong shock amplifying effect in the spiral. We have a Minsky moment when real money investors suddenly think something's wrong and withdraw from risk. That causes initial losses for leveraged mark-to-market investors. They have funding problems. They're also now over-leveraged, even in their own terms. So they have to sell assets. They reduce their positions, and of course everybody reduces positions looking at what the prices are, but everybody's doing it at the same time. And that leads to two effects. One is mark-to-market losses on existing positions, which continue this shock amplifying spiral. And the other is higher margins on repo borrowing, so that when you present a security to be repoed, you can't get as much of a loan from it. And both of these effects were very, very large in the period from 2007 to 2009. You can see from the left-hand chart that if we look at the ABX indexes for credit default swaps on mortgages, the AAA tranches fell from 100 cents on the dollar to under 40. And the other tranches fell to levels of 20 cents or less, just over that period. Some of the AAA tranches, of course, for the subprime, of course, paid nothing in the end. If we look at, on the right side, the haircuts, we see that subprime instruments rapidly became impossible to repo. But even pretty good instruments, the average haircut on structured products rose from essentially 4 or 5 basis points in 2007 to 45%. So you only got 55 cents on the dollar of repoed instruments. So these shock amplifying effects of the Brunnermeyer-Peterson cycle were very, very large. But the financial crisis was actually, in terms of the banks, a tale of two banking crises which were intertwined. Here what I have is the LIBOR or Euribor OIS spread. So everybody knows what LIBOR is. The overnight index swap, the OIS, is a swap of fixed LIBOR for, let's say, 3 months against floating LIBOR. So the OIS swap has essentially no credit risk in it. So when we take the LIBOR OIS spread or the Euribor OIS spread, what we basically get is a measure of bank credit risk as perceived by the market. And the black line shows what happened in...
You go back one stage. Why no credit risk?
Well, suppose you take out suppose I have $1 billion Eurodollar liability and you have $1 billion liability, Eurodollar liability. And I think the interest rate is going to go up over the next 3 months. You think it's going to go down. Okay? So I swap fixed interest for you, you swap floating interest for me, with me, okay? So you're paying me floating interest, I'm paying you fixed interest. If you blow up, I only lose one period of interest on $1 billion loan, which is 1 month, 1 day, 1 week. And then I stop paying you as well. So there's essentially no credit risk in it. Whereas if we were actually holding the instruments, there would be huge credit risk if I was holding. Okay? So there's no, this is a very important index, I think. And what you see here is actually, I'm going to start with LIBOR. Prior to the crisis, the credit risk was, the LIBOR OIS spread for both LIBOR and Euribor, 3 months, was 8 basis points. Okay. Then the crisis hit in August of '07, and it went up to 80 to 100 basis points. And then after Lehman Brothers and AIG, it actually shot up to over 340 basis points. Then the new administration came in, and the new administration, a lot had been done to feed capital into the U.S. banks through the TARP and so on. That had brought it down from a crisis level. But at this point in February, Tim Geithner announced the U.S. stress test system. And basically, you see that there was a monotonic decline in the LIBOR OIS spread. The perceived credit risk of the banks throughout that whole process to the time when the results of the test were announced in May of 2009. That was enormously successful, including the Federal Reserve's information leaks and so on, to get that LIBOR OIS spread to move down. Now, this was a period when the Euribor risk measure went up, but nowhere near as much as was the case in the United States. And the crossing point really came here when the U.S. stress tests were announced. And after that, as you can see, the U.S. Perception of bank risk of U.S. banks borrowing in the London interbank market went up and down to a certain extent, but the concerns moved to the European banks. And the stress tests actually, you can see that, I think this was the first stress test, July the 23rd, 2010, July 2011, and we got this increase during the period of the concerns about the impact on the banking system of a Greek default and possible other defaults. Now, the U.S. crisis was very much a crisis of the originate to distribute model, but the European financial crisis was very much a crisis of an originate to hold model. And that crisis may not yet be over. We don't know. Maybe you can tell me about that. So my point is that both the OTH and OTD bank business models are risky, they're prone to crises, but the dynamics of the crises are different. In the U.S., they came in with a quick and dirty solution in terms of the TARP. They then came in with a measure, the stress tests, which really increased the transparency of the bank's position, and that had a calming effect on the markets. In the European case, there was a perception that the initial stress tests were not very credible, that there were major weak loans on the books of the banks, and that's why that crisis persisted for some time after that. So I think the moral, if we look at the U.S., the leverage in the system prior to the crisis hitting, where was it? Really, the banks, yes, they were leveraged. They're the most leveraged institutions. But the increase in leverage had come in the household sector because of the huge increase in mortgage borrowing. It had come in the investment banks, which had gone into very heavy operations in securitization of assets and taking them off their balance sheet, but funding the warehoused assets with very short-term loans. It came also in the special purpose vehicles held by the regular banks in the United States. That's where the leverage was. And nobody could see it because under the US GAAP consolidation rules at the time, you didn't have to consolidate those special investment vehicles and special purpose vehicles on your balance sheet, even if you had a contractual liquidity facility to provide them if they lost funding. And Citibank alone had 70 of these vehicles. Probably, I haven't looked at the number, but it probably would have increased its balance sheet by at least 40%. IFRS is a much better accounting system from that point of view. So as I've said, the crises had different dynamics, but I think the moral, at least for me, is that high leverage anywhere in the financial system gets reflected in and tends to create distress in the core of the system, the banks.
Can I, just before you go on, I'm trying to get a clear handle on the contrast. The bottom unbold type about European banks, they had large exposures to borrowers in wherever, those listed bad countries. What was it that the OTD banks ended up having credit exposures to, by contrast?
Well, basically, in the case of the U.S. banking system, what they basically ended up with was, in their trading books, they were warehousing these mortgage-backed securities prior to selling them off their balance sheets. Okay, and as they increased that business, the proportion of their, we know that the proportion of their trading book as a fraction of their total balance sheet rose steadily. The banks that when the music stopped and they couldn't get funding, which started in August of 2007, the banks that couldn't get funding, and Bear Stearns was already gone in March of 2008, the banks that had large amounts of those warehoused instruments still on their balance sheets are the ones that took the biggest hits. And those were typically the investment banks.
So instead of having credit exposures to dodgy countries, they had credit exposures created by the warehousing of assets which they haven't managed yet to get rid of.
Yes.
Thanks.
And those, in situations where a bank like Bear Stearns or Lehman Brothers had been, it's very interesting actually, don't want to get too much into the details, but if you look at Lehman Brothers, what happened to Lehman Brothers was that they were very aggressively selling the mezzanine and equity tranches of these assets because they had relatively higher returns. But they found that they couldn't get anybody to buy the AAA tranches. So the AAA tranches built up on their balance sheets. And because the underwriting was so poor, the AAA tranches actually, a lot of them became virtually worthless in the end as well, because of very high failures of the individual subprime mortgages that were holding them up. So those were, that's where the distress came, David, in that that market. And I think the thing that's interesting is it's a very wrenching experience, but it comes quickly. It's signaled by the market. You can see it. You can react to it. And what we know from the accrual accounting in the assets of the European banks, that was a slow motion train wreck, or death by 1,000 cuts, that really impaired the capacity of the European banking system to provide credit to the economy right through the period from late 2009 or early 2010 to quite recently.
Can you explain how the European banks got advantage? Were they just greedy?
I think, well, my own sense is that I'm going to tell you a view here which may not be correct, but I believe that part of the problem here was the fact that the rules of the ECB allowed these things to have a low capital charge. Even though I think these banks knew on a standalone basis that they were very weak. So they were getting a better return than they would have got if they had evaluated the credit risk on a standalone basis. So I think that regulation was partly at fault here. But there are other elements to this as well. There are chunks of the German banking system, for example, that didn't have a very clear business model. And this was really the way they sought to maintain revenues and profitability in the early stages of the crisis. So I think the thing that's really important to me is that they're both very risky models. They both need to be regulated, but their dynamics are very different, and that's what we have to be conscious of. Now, what about the G20 Reform Programme? Well, this was, as I said, the sectors that were, in the United States, the sectors that were hugely leveraged and were, where the problem was focused were households, AIG, which was acting like a bank in providing credit default swap protection, the investment banks, and so on. But what we get is a huge re-regulation of the banks that are left standing, plus a lot of fines, as you know. And I won't recite all of these things. You know them from Basel III. The minimum capital requirements, the capital buffer, the leverage ratio, the liquidity coverage ratio, the net stable funding ratio, the new criterion on the TLAC, which is a gone concern capital criterion, which I think will become the operative one, actually, for banks. You've got to fulfill that. And the higher total loss absorbency for the biggest G-SIBs. So this is a huge package for the banks. And we don't see anything similar to this for all the other institutions that were acting like banks that are in the system as well. So there's a disconnect between the re-regulation of the big banks. There's nothing wrong with what was done. The issue is the degree of consistency between what's being done to these leveraged institutions and other institutions that do the same business. And I think you're familiar with that problem.
Margaret, just one point.
Sure.
Was it expected that the markets would in effect pull this regulation forward? I mean, it was supposed to be phased in, but in effect, it started to bite with them as soon as it was legislated.
Well, that's a very good question. The answer to it is that the markets immediately required the banks to get pretty close to the capital requirements that Basel III wants for 2019.
And that wasn't expected.
It certainly was expected by the banks themselves. They knew it would happen. I was there in 2008, so we knew that would happen. We knew that the timetable specified by the Basel Committee and the heads of supervision at Basel would not be the operative timetable. And the reason is that solvency, weak solvency, it's an ordinal ranking. Whoever's at the bottom is going to get clobbered. And so you don't want to be at the bottom. You're absolutely right. Now, the interesting thing is that the regulators tend to pretend that this is a good thing. We set it out as a scheduled build-up until 2019, and they've already done it. But the other side of that, of course, is that they did it by shrinking their balance sheets. And that meant that it had a very large impact on credit to the private sector. I'm not going to go into detail on this chart or on this slide. It's really the statements that have been made by Mark Carney as head of the FSB about how successful the process of bank re-regulation has been. And he points out common equity requirements are 7 times what they were before the crisis. That might be a good thing, I don't know, but it shouldn't be just for a part of the financial system. That the fully loaded Basel III requirements the banks will have, or do have really, essentially right now, 11% capital, and that's Tier 1 common equity capital in terms of their risk-weighted assets. And here he points it out as a good thing, but trading activities, interbank lending have been markedly reduced. Liquid assets substantially bolstered. Short-term wholesale funding cut, and deposit taking increased. Well, that means that a lot of the processes that are important to the non-bank private sector are much more costly now than they were before. And that's important to remember. Will the G20 Regulatory Reform Programme enhance banking system stability? I guess my argument would be that the regular stress tests done on a consistent set of assumptions for each bank are a very good thing. They really do increase the transparency of the bank's financial position. And they do give, I think, a fairly clear ordinal ranking of the degree of financial strength of each institution. But they give those stress tests really tell the bank's strength relative to idiosyncratic risks. If something happens to Bank A, but not to the rest of the banks in the system, this is an impact effect on both the balance sheet and the P&L. It doesn't tell you what happens afterwards. These are oligopolistic industries, so there's going to be a lot of strategic behavior. It doesn't tell how much the distress of an individual bank will affect others. So it's a very good microprudential device. It's being used as a macroprudential device, and I don't think in its present form it is suitable for that. So my bottom line at this point is that I don't think these measures assure that the banking system is going to remain viable in the broader circumstances of a financial crisis, however it's caused. And of course, the other problem always is these regulations will fundamentally change the way we get around them. I can assure you, having spent a few years in the private sector, that that's exactly the way we used to think. So anyway, that takes me into the questions I have about where we are right now. First of all, I think there are some weaknesses that can limit the effectiveness of G20 reforms in assuring financial system-wide stability. And I've already alluded to them, but let me list them here. There's been a lot of talk about regulating solvency and liquidity in shadow banking, but very little, and we know what needs to be done, and the FSB has been doing a lot of work to try to identify these institutions, but there's no effective strengthening of regulation on those institutions as yet. Secondly, and I'm going to talk about this a little more later, there's excessive homogeneity in the new regulatory rules. Rules that are very good for highly leveraged investors to moderate their behavior and make them less risky should not necessarily be applied to other transactors. I think that's a very important point. I'm going to give an example of it later. And it relates to my next point, which is we're working in a system which is a marketplace. A shock which creates a stress and a large loss for one transactor in the market must, by definition, be a potential gain for another transactor. So we have to be careful that we have endogenous risk in this system. It's like the Millennium Bridge. Everything's fine until somebody starts walking on it, but then the whole thing starts to vibrate. Not my analogy, it's Sun Shin's, but it's a great one. But there also should be endogenous shock absorbers in the system. That's what they put on the Millennium Bridge, right? Because it doesn't do this anymore. So let's build a regulatory system that strengthens the endogenous shock absorbers. I'll talk a little bit more about that in a second. So I'm not so sure that what the G20 has done, which is to focus very much on the G-SIBs, and in terms of implementation, not do so much to the broader financial ecosystem. I don't think that that's going to create a system which will mean that nobody's too big to fail, or that there won't be any more crises, or that if a stress occurs, the regulators will be able to take care of it. Now, you might say, well, but wait a second, we've got these macroprudential.
Could you just go back to the end of the previous slide for a minute? You're making the distinction between, if you like, microprudential strengthening, whilst leaving the macroprudential not well enough analysed, understood, or acted on. Surely microprudential improvements will dampen the interconnected propagation of a shock.
I don't think that's clear.
Right.
It will dampen it, to the extent that a bank has a lot more solvency than it had before.
Like 7
It
times
won't.
as much equity.
It will not have to. It will not engage in the same kind of fire sale behavior.
That was my point.
But it's still interconnected. And for example, the liquidity coverage ratio rules, I think, are likely to increase the interconnectedness of these institutions under stress. So this is an area that needs to be researched a lot more, but it's not an obvious proposition that just increasing solvency and liquidity is going to reduce interconnectedness and the way that contagion is propagated as a result of that.
Yeah, there you go. That's where you go.
This is probably the central bank that's done the most work on macroprudential policy tools is the Bank of England. And probably the institution that has the best governance and clarity of mandate for the use of macroprudential tools is the Bank of England. If we look at the FSOC in the United States, both the deputy chairman of the Fed, Stanley Fischer, and another governor, Lael Brainerd, have said pretty clearly in speeches that they do not have the mandate to implement macroprudential regulation. If you look at their speeches, I think it's very politely said, but I think it'll be quite clear that they don't want to have a mandate or to be expected to act as macroprudential regulators if they lack the discretion and the tools to do that. Now, in the UK, there is a degree of discretion exercised by the Financial Policy Committee. But this is the list of macroprudential policy tools that is given in the Bank of England article that I cite. And if you have a look at them, it's very interesting. Countercyclical capital buffers, restrictions on distributions, maximum leverage ratios, minimum liquidity buffers, time-varying loan-to-value and loan-to-income ratios. What's interesting about those macroprudential tools? Well, what's interesting about them is that they're the same thing that we call microprudential tools. Okay? There's nothing in here which increases the endogenous shock absorbers in the system. And there's a very big issue here, which to some extent has been addressed by the Bank of England, but I would say not by any of the other macroprudential regulatory authorities. And that's right there in purple. Macroprudential policies have to be time varying. You have to tighten up the buffers, you have to raise solvency requirements based on your assessment of the vulnerability of the system. That's going to be a tough, very political issue. And so the question is, should time varying, they have to be time varying macroprudential rules. You have to tighten things up as the system is exposed to more risk, becomes more leveraged, has more concentrated risk exposures. You also have to be able to loosen all those things when the system's in the middle of the crisis and the institutions look really weak. And so the question is, they have to be time varying. Are they going to be time varying according to some mathematical rule? Or is the authority going to be given discretion? Nobody's answered that question very effectively, with the exception of the Bank of England. There we know what they can do and when they can do it, but I think from a political economy point of view, it's still a problem.
So just a question, macro-proof is sort of complicated and very hard to write down a rule to stabilize it.
Exactly.
So is that just in your opinion, a false step? It's got to be discretionary.
Pardon me?
It's got to be discretionary, hasn't it?
Well, I think that, the rules for the cyclically adjusted buffer, which is supposed to be a macroprudential rule, is supposed to be formula-based. So this is an unanswered question in this particular situation. Now, stricter bank regulation is causing a lot of structural change in the financial system. And I'm not going to go into the details here because I don't have time, but basically what's happening is that structural change is making a lot of standard banking activities unprofitable to banks. They can't earn the market rate of return on it. So it's moving to other segments of the system. There's also the issue of the inconsistency between regulatory policy and monetary policy. That's a risk. Zero policy interest rates and rounds of quantitative easing by the key reserve centers have made market interest rates very low. And many other central banks have followed that because of this problem that if they don't, their real exchange rates get seriously overvalued. Now the Fed's begun to exit this highly accommodative monetary policy. But it's not clear how quickly it's going to be able to do it. And it isn't just whether Brexit will happen on June the 23rd. It's the issue that if they do it too quickly, the exchange rate of the US dollar will strengthen too much. And that's really, I think, the issue that concerns them. But the basic point is that given the huge incentives for reach for yield that are there, and given that the banks can't take these incentives anymore, the positions of reaching for yield are moving out into other areas of the financial system. Exactly what I was saying in the cartoon. Now, also, the financial system innovates all the time. Innovation appears to be very cheap in the financial system. I won't go into why that's true. But the basic point here is that a lot of innovation is extremely useful, particularly in the plumbing. We've got a lot of new payments initiatives that are taking place that will make payments less costly for you and me. But a lot of the innovations are for purposes of regulatory arbitrage. It's to get the risk out of the regulated entity and into an entity that the regulatory authorities can't see. And so this means that the leverage is probably moving in the system to other parts of the financial system, outside the banking system, as a result of this differential regulation. Now, where are these sectoral risk concentrations? Well, of course, some of it is in the banks in the sense of residential and commercial mortgage markets, but there's a lot of mortgage lending now that is taking place outside the regulated banks. And also there's a revival of securitization of mortgage products. There's been a huge amount of debt issuance since 2012 or so, particularly by non-financial corporations in emerging market economies. And these are going to have to be rolled over at some stage. So that's another area where leverage has hugely increased. There's continued issuance of sovereign debt. Sovereign debt hasn't been brought down, so that's a leverage issue. Currency carry trades, not so important perhaps right now, but huge positions were built up over 2010 to 2014. These are entities we really don't know anything about, but we know from their effects on exchange rates that they must have been fairly large positions, and they probably haven't been totally unwound. And then we have a lot of leverage coming through securities lending, repo markets, and the securitization of securitized products. Now, what's the implication of that? The implication to me is we can't look at all of these subsectors of the financial system and calculate a Basel III type risk-weighted asset ratio. But there's no reason why we can't look at the leverage ratios and the concentrated, the crowded trades of various subsectors of the financial system. So we ought to be building an asset sector matrix of every economy. It can be built on the data that's used for flow of funds data, and I know the flow of funds accounts are not very developed in Britain, but they're quite developed in 30 or 40 countries. That's where we should be looking to find where the leverage is and where the vulnerabilities are. What will the next financial crisis look like? Somebody asked me, when will the next financial crisis occur? I can say categorically that we can't predict that because it depends on when real money investors decide that the assets of the institutions they have their holdings in aren't good assets, and we don't know when that will be. But what will the next financial crisis look like? I think one point that's interesting is the markets are not going to allow private sector entities that are not regulated like the big banks to take on anywhere near as much leverage as the banks have. Now you might say, well, that's a good thing. That really helps. But it means two things, really. One is that although we don't know where the leverage is, there still is leverage out there. And secondly, it means that these entities need to be the subject of more careful investigation. So, and the other the final thing is that as these activities that have been taken on by regulated banks in the past move out to institutions that do the same thing but can't get as much leverage from the market, their intermediation spreads have to be higher to make an economic rate of return. So the degree of efficiency in the system goes down. And that's why there's this trade-off between the amount of regulation or the strength of regulation and the efficiency of the system. Now, so when a stress occurs, I think it's the combination of leverage and interconnections that transmits the contagion through fire sales, the evaporation of funding liquidity, and so on. And my argument is that a lot of the leverage has moved out of the core of the system and gone to these other activities. And this, I think, will make the dynamic of the next crisis quite different from the dynamic of the last one. Does it mean that we'll have a fairly salubrious crisis next time, like the dot-com bubble or the stock market crash of 1987? These were very, very uncomfortable for certain groups, but they didn't cause a near meltdown in the system.
Because they were equities. Because they were equities rather than
Well,
what's debt.
it's partly, I would argue it's more that the asset holders that were hit by this weren't leveraged very much. And yes, it is also, you're automatically bailed in when you hold an equity.
Yeah.
So that is also true, I think. But I think that it's not necessarily true that this would be a lot less damaging crisis. We wouldn't have the same effects at the core of the system, but I still think there are three caveats to the idea it wouldn't be that bad. First, the greatly increased solvency requirements on the G-SIBs mean that they do much less market-making activity. So there's a lot less market liquidity, and that means that the price effects of the deleveraging in this crisis would still be pretty large. Second, the G-SIBs themselves are still highly leveraged institutions, so if there's distress in other subsectors of the financial system, it is likely that it will be transmitted back to the large banks in some way. And then the macroprudential regulators will have to decide how much they're going to relax certain macroprudential buffers and so on. And third, again, there have to be economic agents that are not only willing to benefit from the distress of other actors, but are able to do it. And here's where I think there might be a bit of a flaw in the G20 rules and in the general regulatory rules. If we look at the rules that have been imposed on banks, they're rules that are intended to reduce distress in individual, badly managed, or unlucky, highly leveraged institutions. And that will reduce the size of the fire sale problem. But what we really want is a situation where when those leveraged investors have to sell, there are other investors who will have a profit incentive to buy. And who are those investors? Well, we know who they are. Pension funds, insurance companies, sovereign wealth funds, and at least theoretically, the household sector. These are unleveraged, generally unleveraged, buy-side investors. Now, when I look at Solvency II, it looks to me as though the solvency of insurance companies is now going to be calculated based on the fair market value of its assets, the solvency ratio. Okay? That sounds like a good idea, and it is a good idea for a leveraged investor. But a well-managed insurance company has a replicating portfolio. It has a set of assets that are supposed to pay off in time and in value its expected liability plus a buffer that it holds. And the buffer has to be higher than what the regulators want, because the regulators only want to put it into, they want it to have enough assets in the worst situation they can think of that it can be put into runoff. But a well-run insurance company wants to be able to still write insurance. They want to have good enough credit rating after a bad event to still write insurance. So they want more. They should want more. Unlike a bank, they should want more capital than the regulators think they need. Okay? It's a going concern, gone concern issue. If we, for regulatory purposes, treat the insurance companies like we treat leveraged investors and say, well, the value of their assets has gone down, so they can't buy any assets, even though they have huge cash flow coming in. We're breaking an endogenous shock absorber that could be there. That, I think, is the last point I'll make. I have one or two other slides, but you can look at them at your leisure. But I think this point about endogenous shock absorbers and not doing anything on the regulatory side to weaken them is a point that, from my impression, is that it is being missed by the regulators right now.